Good day to one and all. This is Dr. Sivaraman of iknowintersys.com. So once a month, I give the twin webinar in FX Street, tracking the forex market together. Part 1 during that of the early part of the European session, and part 2 during that of the early part of the US session. So today we are on 15th of September between 8 and 8:45 GMT. I'll give the first part of the webinar. So it is a simple live market tracking technique I am going to explain. And also you will understand that it becomes an effective trading strategy to earn consistently from the other market. So if you are benefited following this particular tracking and also trading strategy, you can use it appropriately in your trading. So first of all, I'll explain to you how exactly we proceed with that. Now, in order to track the market, we require three components, namely the derived forecast, then the market reading, and the trading strategy. So the derived forecast, I have given it on Monday, yesterday, during the Asian Session Live Market Analysis webinar. And there I have mentioned the expected market moves for the entire week. So my forecast is based on a unique statistical algorithm with which I'll be in a position to give the forecast session-wise or every 30 minutes, and also for the day, week, month, years, and multi-years. So here I have given the forecast for the week, and today we are on 15th of September, and the market is expected to make the swing and slide, then swing and slide during the of the European session. And yesterday you would have noticed that during the European session, they gained the levels quickly early part of the European session and then started making the slide. And they are continuing the slide with small swings. Session starts small swings on the upside so that the traders will think that the market might bounce and go up and try to take a buy position. And then later on, the players avoid rising and start making the slide close of the session. And after the drop, some traders might go in for a short sell after the drop as a breakout trade. And for that, they could make a small form of move during that of the US session. So today we are going to do the live trading during that of the European session and during that of the US session. So now European session start in part 1. I'm going to do the sell and buy trade in the case of Euro and GBP based on the forecast. Besides, this is a gross decision. Based on the forecast, it is appropriate to do the sell and buy trade in Euro and GBP because they are expected to make a small form up here or a swing near that of the high or intermediary level and start making the slide. Now, in order to confirm whether they are going to do that, the second component, namely the market reading, I'm going to do that. So for market reading, I note down on a daily basis the initial lows and the highs set by 3:30 GMT. During the early part of the Japanese session, they set the initial lows and the highs, and they use it for a specific purpose. And based on that, they try to make the moves in the market so that they will be able to really have a total control over that of the market. So we also note down the initial lows and the highs around 3:30. And now we are in the European session. It is 8:04 GMT. 8:04 GMT. So let us understand in relation to that of the 3:30 GMT, the levels, where exactly they are. Okay. Now I'll take the live market page and compare it with the initial lows and the highs they are set. Now current level in the case of Euro is 1.1314 and the initial low was 1.1301 They breached the low and formed a new low 1.1284 during the late Japanese session because they are expected to make the swing and slide. That's what they breached the low and come above that of the low. And then the high also, they made a small breach, 1.1321. They went 7 pips above as a stop end before making the slide. So now what they will do, they'll make a small firm up and go to that of 1320 or so, and then start making the slide. So this is what they intend to make in the case of Euro. Now, in the case of, because they have done the either way stop ends and they are just making the swings in a small range. And in the case of GBP, 1.5418 was the initial low. They made a brief downward stop end of 16 pips, 1.5402, and then started gaining the level. 1.5432 was the initial high. They went up to 1.5449 and then stopped cutting the high. And then they are holding it. Now they are expected to slowly slide GBP also. So we will try to take the sell position in the case of GBP also. In the case of yen, 120.18 was the initial low. They just breached the initial low, came down to 119.45 and still staying below that of 120.18. 120.65 is the high, which is intact. So we will try to watch how they are going to handle the new low. They have formed 119.45, and if they don't breach it for 30 minutes of our observation, then we will try to take a buy there. Then in the case of CHF, 96.77 was the initial low. They just breached it by 7 pips, came down, and then started gaining the level. 96.92 is the high. They just breached the high and going above. So they are likely to go above, further up. So we'll try to do a buy and sell trade there. And in the case of Canadian dollar, 32.60, 32.50 is the low. They just breached it to 32.44. They are holding it. They hold below that low for more than 30 minutes. We'll try to do a sell and buy trade there. The high also, they just breached it by 3 pips. 32.64, they went up to 32.67 and come down. So a brief upward stop and to make a downward move. So we'll do a sell and buy trade in the case of Canadian dollar. Australian dollar, 71.23 is the low. They are just holding around that. 71.66 is the high. They just hold it without breaching the high. And they breached the low and came below to 71.04 and holding around 71.23. So we can do a sell and buy trade, and they are expected to make a slide in the case of Australian dollar. So our decisions are based a broad decision that we will do sell and buy trade using the forecast. Then market reading, we do it, understanding the type of moves they are doing it in the market. So I have shown it, they have done the brief upward stop and then come down. So invariably, they are expected to make the USD gaining move. So the derived forecast, market reading, and the trading strategy. I'll explain the trading strategy later on. So first of all, market reading, we note down the initial lows and the highs around 3:30 GMT and try to compare whatever the session we have and compare and find out with the help of the live market page and the initial lows and the highs they are set around 3:30 GMT to find where exactly the market is. And then we will be able to find out the type of moves they are doing it in the market. The type of moves, namely the stop and false move, extended move, intentional move, and the swings. So during the early part of the session, they will do the stop and or a false move. What is the early part of the session? The extended move during that of the European or the US session, they will make a quick opposite move, a cunning move before that of the intentional move they intend to make it, which will run for 2 sessions and start of the 3rd session. The swing, they do it near that of the high or near that of the low, and then the opposite move they do it. So today in the European section, the focus says swing and slide. So near that of the high, they will make a small up and down move and then slowly slide. So this is what the forecast says. They are holding it now. Slowly they are making a dip. And the market timings are important. The day is divided into three sessions, Japanese, European, and the US session. The timings are given here. So we are in the 30 minutes past the start of the European session. So 7:30 to 9 is the early part of the European session. We watch for 30 minutes from the start of the session up to 8 GMT. And if they don't breach the high and they are near that of the high, we'll try to take a sell position. And if they are near that of the low, not breach the low for more than 30 minutes of our observation from the session start, then we'll try to do a buy and sell trade. So as we go, I think we should take the position first. Otherwise, they will make the move. Afterwards, I'll explain about the trading strategy. So we will first of all commit the positions. So we'll try to take a sell position. $1.1313 with the 30 pips hedge order. The hedge order will be a buy stop in MetaTrader platform. 30 pips above. 1.1343. Then in the case of GBP, 1.5436. So it will be a sell position, and 30 pips above will keep the buy stop. Then in the case of yen, I was telling you that they cut the low 119.45. They just cut it by 1 pip and come up. So they will try, if you try to take a buy, they will try to hit the stop and then come up, hit the stop and come up. So it is not appropriate to take, and they are doing the extended downward move before making an upward move there in the case of yen. So near the low, probably 119.40 or 42 will keep a buy position, buy limit order. Okay, I'll keep it as 119.43. Just 44 is the low. They just 1 pip below that, so that if they hit, I'll get a buy and keep 30 pips hedge order to limit the risk. So the sell stop for the buy position, 119.13. This is only a buy limit order. It's not a position. I have not taken it, the position. Only if they fill it, I'll be able to get it. Then, in the case of CHF, they already breached the initial high and going above. So I'll keep about 96.95 as the buy limit. Just I am fine tuning my entry. Just keeping an order 3 pips below that of the market, so that when they make a small swing, they'll be able to hit my buy limit. It's a fine tuning method, or I just fine tune my entry. Yes. Then keep 30 pips hedge order below that. That will be sell stop. So 9665. So in 4 majors, I just taken 2 positions, in GBP, and in the case of yen and CHF, I just kept the buy limit order. Now we'll come to the top. We'll watch how exactly they are making the moves. So we need to understand that the market moves in tandem with our forecast, and we fine tune the forecast using the market reading technique and enter into the market so that we should be able to get definite profit in the event if the market goes against us. There's a contingency plan. We have the hedge order to limit the risk. Okay. When you keep the hedge order to limit the risk, what happens? So in the event if the market goes against us suddenly, and then the hedge will be filled, and we watch the hedge, whether it is making profit or loss. And if it is not making profit for 30 minutes, we understand during a brief stop and they filled our stop. And also some of the platform, they know where we have kept our stops. No, in the platform, they can easily, the broker dealer can easily identify where the stops are. They can just hit the stop or hit the hedge order before the market coming down, so that we will get really struck. And they wanted to earn money that way. So what you have to do is, in such a scenario, you have to keep either the hedge order about 45 pips away from that of the market instead of 30 pips. The other alternative is, once they hedge it for 10 minutes, if they don't show the profit in the hedge, immediately close it with 2-3 pips loss and keep another 30 pips above the hedge order, so that the chances of the hedge being hit frequently will get reduced. Because nowadays, the players also do frequent up and down moves in order to hit the stops or hit the hedge orders and to earn money. So we need to understand, when the trader's commitment is less, the players try to hit the stops of those who are already committed positions, so that they will have a definite profit by hitting the stops. So when they hit the stop, we buy at the higher level, but they sell at the higher level. And when you buy back, when you liquidate a long position, suppose you have got a long position and suddenly the market drops, then we liquidate the long position at the lower level. That is, we buy at a higher level and liquidate at the lower level or sell at the lower level. What happens? They buy it from us. So they sell high and buy low. But they induced all the traders to do buy high and sell low. And simply they say that it is a technical trade, you can buy high, and a breakout trade, you can buy high. And then later on they say it is a false breakout. Then now all the traders are curious to know how to identify the false breakout from that of the true breakout. So it is a never-ending quest. So people will try to say that this could be the possible reason, because earlier people were telling about the pivot point, the MACD, parabolic curve, and the meeting of the cross sections of various type of curves. And now you find that nowhere the traders are able to get a foolproof system of trading. So now they are telling that they're reliable breakout trades. So ultimately you will come across, people will say that the possible trading method or reliable trading method, etc. But the chances of getting it reliable still will be a question mark. So ultimately, why it happens like that? Being a statistics professor, I am just telling you that if the market is not manipulated, all statistics will work perfectly well in the market. I think we got our 119.43 filled. So it will be a buy position. Hope you are able to understand why I am keeping a limit order like that, 2-3 pips below the market, so that it is a fine-tuned entry. Yes, we try to enter with 2-3 pips fine-tuned, so that will add profit. And also the stop getting hit or the hedge order getting filled will be of a lesser chance. If you simply take a buy and keep the hedge order, and if they hit the hedge order, and if you simply blame the market, that means that you are impulsive. And somebody has asked a question, Sirat, in question and answer window, what are we waiting for? And so that shows how impulsive people are. No, they don't have the mindset to wait. Actually, we have been waiting for the 8 GMT to commence, then can start the webinar. That is why we have been waiting for about 5 minutes. And that 5 minutes, he was not in a position to wait. So the first virtue to become a successful trader is the patience. So if you try to develop the patience, you'll be able to really take advantage of the market moves. So that is what we need to identify. Now coming to that of the tradings, I'll explain it. Okay. Now coming to that of the type of moves they are doing it. So I showed you the levels, the timings of the market. So in our forecast, we follow the levels as well as the timings. So in other type of market analysis, you don't have the time frame. We use 30 minutes chart, 1 hour chart, 4 hours chart. That is not the time frame. We identify which part of the market we are going to enter, which part of the market we are going to exit. The early and the late sessions, they handle the majors. So if you want to take the positions in the majors, we wait for the early sessions to come and wait for 30 minutes. If they don't breach the high and stay near that of the high, we take a sell. If they don't breach the low and stay near that of the low, we take a buy. The exact opposite, they will do it during that of the late session. We don't require any forecast. The exact opposite, what they have done it during the early session, they will do it during the late session. That is, we have to wait till 11:30 and 11:30 to 13 GMT, you will see the opposite move. So they have made a brief upward move during the early session. So from 11:30 to 13 GMT, they will make a downward move. At the time, you can cover your short. So by looking at the early session, you can say what is going to happen. You will be able to predict it on your own. Within the session, if you follow the session timings, you don't require anything else. And the gap time between the European and the US session, they'll make a false move. Then US session again, we will come by 14 GMT and try to take the position depending upon the type of move they are doing it at that time. So always we try to commit a position when the spread becomes more than 40 pips between the high and the low, then we will try to commit a position because that currency or those currencies will make quick moves in the market. Within the session, we'll be able to close with a profit. Then they always do the intentional move. Prior to that, they make the extended move. So during the session start and the session close time, they make the stop and or a false move during the gap time and extended move when they do it. So in the day, extended move, they just make during the European session, for example, on the upside, after 2 hours, they will just make the slide. And then you will come across the slide is an intentional move on the downside. So that way we'll be able to identify. So extended move is a quick move which happens for more than 30 minutes up to 2 hours. So all quick moves in the market are false moves. That means they wanted to make the quick moves to induce the traders to perceive the market is going to go up. Whenever quickly it runs up, then immediately somebody thinks that, okay, I should jump into the running bus so that I'll be able to reach the destination very fast. The destination is on the reverse. So they will just quickly make one upward move and all will jump as a breakout trade and slowly they will make the slide. So such upward move and stop cutting the new high for more than 30 minutes indicate that they wanted to make the slide. Then we have to take the sell position. We'll be able to really book profit after the extended move. So intentional move is a slow move. Pip by pip, they will make the slide. And every 30 minutes, they will breach the new low and continue it for 2 sessions on the start of the 3rd session. So that way they make the intentional move. And if you follow the intentional move, you can easily wait for the 3rd session start time and book profit. So you should be able to get about 100 to 150 pips profit when you have the position in the right direction during the intentional move. And the intentional move will be invariably in line with the forecast what is given. So if you follow the forecast, you'll be able to really get the benefit out of the trades. Then the trading strategy. In the event there are breakout news or there are sudden knee-jerk reactions in the market. So how exactly we are going to handle the situation? Suppose you're taking a buy and the market suddenly goes up and it gives a fear for you that it could indefinitely rise. That is how it will pretend. So immediately many of the traders go and hedge and later on find, okay, they hedged it at the highest level and afterwards the market is not breaching that. That shows that emotionally they hedged the position. So the player's main target are being the emotional traders. So they make the quick drop or quick rise mainly to trigger the emotions of such impulsive traders. So if you want to be a safe trader, control your emotions. I can simply say control your emotions, but how to do that? So if you want to control your emotions, stop looking at that of the candles. You only look into that of the live market code page. Why I'm telling this? Because in the candle, when the market is making a small swing like this, 1 pip or 2 pip will appear like a moderate candle. And they make a quick drop of 5 pips and it will become a bigger candle. If they drop about 15 pips, it will be much bigger red candle. Immediately it will give the trigger for you. Okay, 3 red candles, so we'll try to take a sell. Then the market reverses and goes up. Because hardly they made a false move on the downside for 15 pips, for a stop and for 15 pips, and then they wanted to reverse. So that you are not identified. Instead, you have been depending upon the candle. So when the candle becomes red or green, depending upon that, if you try to commit the positions, invariably you find that emotional traders are trapped with the wrong positions. So all quick moves are false move. When there is a quick move on the downside, understand whether they form the new low, stop cutting new low for 30 minutes. That means they want to reverse. If they continue to breach the new low every 30 minutes, then it is intentional move on the downside. Then you can do a sell and buy trade. Instead, if you just, when they quickly made a drop to 1.5402 and then you take a sell there, thinking that it is a breakout trade, they will form up. No, that's what you need to understand. How traders get trapped, because by looking at the candle, when the market consolidates, the candles become moderate sized. And once the market makes a quick whipsaw move for 15 pips on the upside and 15 pips on the downside, then immediately the candles get exaggerated in such a narrow spread, then automatically the traders are being triggered to become emotional and commit. And immediately thinks that, okay, let me do the breakout trade. Then later on he finds that he has done a wrong entry. Then later on he will try to justify without accepting that he was emotionally committed a wrong position. He will try to justify, no, I was only following the candle perfectly. I was looking for a breakout and it happened. And then I took a buy safely and I expected the market to go up, but it came down. All crazy market. That's what you will simply say. Because those who use the word crazy market, they are all emotional. Because if you don't understand why they have done it, then you use the word crazy. And so when you use the word crazy, that means a surprise has happened to us. And the surprise becomes the trigger for you to develop the market fear. So expect the unexpected. Okay, I've taken a sell position. The market can go up also. In the event if that goes against me, what are the plans I have? So that you know when the market goes against, what I'm going to do. And if the market moves in my favor, what I'm going to do. I have the plan. So automatically, I find that I don't become surprised with the market move. Once I don't become surprised, then there is no emotional trigger. And if there is no emotional trigger, I make simple, sensible trades in the market. So the distractions for the traders are namely asking the traders to follow technicals and fundamentals, and then the players create the market sentiment that market is going to be bearish, market is going to be bullish like that. When the traders commit the position, the players simply reverse the market by telling some other attribute. So that is one way of trapping. So if you continue to follow technical and fundamental analysis, they continue to trap you. And in the process, some of the occasions you might make profit, some of the other occasions you might be stopped out. So you'll be at the start point. And you may say that I have got 5 years of experience, 7 years of experience, and things like that. How much of money you earned? Okay, 5% of my total equity. So even if you had deposited the money in the bank with the lowest interest rate, you would have got that 5% over a period of 5 years. So that we don't accept. We'll say that no, trading is a tricky thing. I can only do that. So out of ego, we continue to blame the market, and without understanding, we have to blame ourselves. And simply we say that I'm experienced, but I'm not objectively looking at the market. Now, in the event if the position is hedged, we need to know how exactly this is going to be handled. If they hedge and in 10 to 30 minutes, the hedging is making loss, that means they filled my position during a brief upward stop, and then what happens? During an upward stop, and when the position got filled and then they made the slide, so I got struck with a high level buy. And then in 10 minutes, we find that it is not making profit. Close it with 2-3 pips loss and keep another hedge order. See how they are doing it slowly in the mid session. A contrarian move by dropping euro and gaining GBP. This is mainly to drop euro GBP cross. Now you can refer our position and see what is happening. Then you will be able to understand. Then in the event they hedge us and the hedging is making profit for 30 minutes, that means our hedging got filled and the market is going in the opposite direction. And keep stop at entry in the hedge, the buy position. And if they continue to gain and they don't hit your hedge position, you can simply close your buy position and maximize the profit on the sell side. Close the sell position and maximize the profit on the buy side. Because we know that it is an intentional move on the upside, we should be able to earn about 100 to 150 pips. Closing with 35, 40 pips loss of the buy sell position is not a matter much, because we will be able to earn about 125, 150 pips. Out of that, 40 pips goes, then 110 pips net profit we will have. So we'll be able to reverse the trade if we have the hedging facility. Or if we know that market means swings, they have to do upward move one day, downward move other day. That is what they do it every time. They cannot bring euro to zero and take it to infinity the next day. It is not possible. They have to make up and down move in a range, and then they break the range after some time. So if you hold the buy and the sell position, and wait for 75 pips or 100 pips profit in the buy side, and wait for 150 pips profit on the sell side, then you'll see that they will hit both the limit orders or take profit orders, and you will have altogether profit in your either way trading. So it is something like some trader is holding buy position, another trader is holding sell position, and if he has got the limit and calmly wait, with a less exposure to that other market. Over trading is the risky thing. If you overtrade and take too many positions, then you will find that you are trapped. Otherwise, we are not at all trapped in the market if you're going for a moderate leverage position. That is 1:50 or 1:100. If you take the buy or sell position, only one position, and keep limit order without even a stop, you will be able to book profit in a day or two, when they are making up and down moves in the market. But if you take too many positions and if the market goes against, immediately your equity erodes, and that gives the trigger for you to close all the position with a loss. And the next day you repent, because you understand that if I would have kept the position open, I would have booked profit. But what happened? The wrong thing comes first before the right thing. It is something like the risk reward ratio. That is, you take a risk of one part and the reward of three parts. That is, you expect the market, you take a position, keep 100 pips stop, and keep 300 pips limit order as a reward. But what happens? The market drops 100 pips and hit your stop first. So in the risk reward, before seeing the reward, the risk has been noticed. So this is what happens in the market. And then 100 pips loss, you find it is really shocking. So theoretically, so many things can be said. But if a stop is placed even for 15 pips in a standard lot, then you find $150 will lose. So if you keep 30 pips stop, $300 you lose. If you continue to see that stops are hit for 4-5 times, then 300 into 5, $1,500 gone. Do you think that you will continue trading? Not at all. So instead, if you keep the hedge order, and if it is hedged, then you handle hedge to do either way trading by blocking the fund. It is something like investment. If the position is hedged, then you have made an investment of 30 pips, $300 there. And afterwards, anyhow, you have kept the deposit with them, with the platform providers. And later on, you find that both the positions, you are in a position to book profit. See, now you can see how they pretended by gaining the levels in the case of GBP and making the drop in the case of Euro. And then it appeared as if the market is going to go up. So how exactly they have done it? Now you are able to see before your eyes that what pretension they do, we should capitalize it. We should not believe what is appearing in the market as true things. So, what is the hidden agenda of the player is vital. Now, coming to our positions, what I committed earlier, now Euro is making 13 pips or 12 pips profit, and GBP is in slight loss, and my hedge is not being filled 54.66. And once the position makes about 20 pips profit, I'll keep stop at entry and remove the hedge order. Then the purpose of hedge order is removed, or the purpose of hedge order is over, then I will try to trail the stop in a profit making position by maintaining 15 pips away from the market. Now I understand that they will make an intentional move on the downside. So I will maintain the trailing stop because they will cut the low, stay near the low, cut the low, and just every half an hour they will cut the new low again by 5 pips, 10 pips and hold, 5 pips, 10 pips and hold. Then people might think that, okay, now this is a strong support level, 1.1267. So we should try to take a buy. Later, they will bounce about 10 pips or 15 pips and then breach the low and go below. So they will try to trap every type of analyst in the market. So ultimately, what is important? Reading the intentions of the player, whether they are doing intentional move or the extended move. Intentional move is a slow move, either on the downside or on the upside. But whereas the extended move is a quick upward move. All quick moves or false moves in the market, either on the upside or on the downside. That we need to understand. So if there are questions, I'll answer to those questions. Okay. Then Maria's got a question. How useful is the court report? See, court report is a report with regard to the broker. So whatever the broker says with regard to his clients, and many of the brokers say that we have got about 20,000 clients and 50,000 clients. I doubt very much because if you hardly communicate with, if you communicate with those who are in forex market with all methods or efficiency and things like that, you hardly find that about 100 to 150 traders are very active in the market. The rest of the traders are passive traders. And there you come across the institutional trading is also equally important. And the small traders percentage is insignificant. So there you do not come across the institutional positions. And also you find they don't give it as a foolproof system. They will simply report, okay, this is what predominant of the traders are long, predominant of the traders are short, and things like that. This is basically, when you find that none of the technical analysis are working, they wanted to introduce a new method for the traders to follow. It is something like a gambling den. You go to the gambling den, you find that you earn first and then subsequently you lose. Then you hesitate betting money. And immediately they will simply say that, see, this particular guy is really earning very nice money. Why not you bet along with him? That's what they will say. And without knowing why I should follow that person, without having an adequate reason, you simply follow him and bet. And there again you lose. And that man also lose. Then that man says that just because you have bet along with me, I also lost. But that man happened to be the man of the owner of the gambling den. So ultimately, we have to understand that they will give various methods of analysis. It is something like your eyes are tied up, you are not able to see, and you are trying to figure out something in dark. So in that process, they will give you a rope and then you identify it as a snake. That's what happens. It will usually be almost 1 week out of date. Okay, you are confirmed. Can we use parabolic SAR to determine the stop loss? Not at all, sir. Not at all. You try and find out on your own, because I have tried all the methods and found that the players are very, very specific where the cluster of stops are. They hit the stops. Even if the stops are about 150 pips away from the market. And if plenty of such stops are there, already the traders have taken adequate long positions. They make simply one extended downward stop and for 150 pips and reverse on the same day. Many of the occasions they have done it. And you know that a lot of traders have taken the stop or kept the stop above that of 1.1655 in euro. They took exactly to 1.1710 and then dropped currently where they are trading. What you can understand with this? If there is not much movement in the late session, do we look for other pairs instead? No, if the spread between the high and the low is not more than 40 pips, don't commit any position in those currencies. Only where there is spread, adequate spread of more than 40 pips, you commit. And trading crosses requires a different method. And so don't simply use the same method to trade in crosses, because in crosses you need to find out they have to make the contrarian move. So now euro is making 14 pips negative net change, USD is making 75 pips, 76 pips negative net change. So that means euro is making USD gaining move, whereas USD is making USD weakening move, which is called as a contrarian move. When they make such contrarian move, you find that euro yen comes down much more than these figures. So it has come down by 99 pips. So you have to identify what sort of contrarian moves they are doing it and then commit positions. So simply looking into the various currencies and find out, okay, the spread is more and simply take one position, that's nothing but gambling, taking a chance. You have to do the market reading, use the initial lows and the highs, compare it, identify what type of move they are doing it, then you try to commit a position. Because, see, you should not try to take chances. And in the chances, you find it invariably works out to be 50-50. If you take continuously the chances, the probability theory says that you will have the equilibrium with it. Okay. Then Sharon, the late and the early sessions are intended only for the majors, Euro and GB, yes. And if you cannot see 40 pips and more spread on these pairs, timeout, it is better not to enter. Yes, you are right. And what at least 40 pips spread before deciding to enter. Yes, they are done more than 40 pips spread between the high and the low, then you can take a commitment. Near the high, you can take a sell. Near the low, you can take a buy. They are not breach the low or the high for 30 minutes during the early part of the session. In any, what could be the lowest level for Euro GBP and Euro Yen crosses? So when you ask like this, you stick on to those levels, and invariably you develop a mental picture that GBP could, or Euro GBP could go to 0.71. So then when it is around 7.3, you feel like selling without understanding whether it is near the low or near the high, whether the spread is more, whether you can do a buy and sell trade or a sell and buy trade. You simply ask for such levels. See, if I am God, then I can tell you, okay, Euro GBP will go to 0.7176 and reverse. But I am not God. So I can only theoretically estimate or mathematically estimate, and I cannot control the players. No, I give the forecast that Euro GBP will come to 0.7315, and afterwards you should not drop. I cannot tell them. Because if they come across plenty of stop around 92.95, they will come down up to 92.18 and reverse it. So asking such questions invariably shows that you are trying to develop a mental picture, or you have a lower level sell and you wanted to find out whether I am going to give a level, thereby you can wait and book profit on that. Don't gamble with regard to the positions. That's what my humble advice will be. So always study the type of moves and find out what could be the low and what could be the high. And Sharon, hello, are you using other platform rather than MT? Ask other question. Okay, Raja. In 20 pips to 25 pips profit, should we stop at entry or remove hedge or trade? So if you are aiming for about 25 pips profit, you can continue to hold the hedge order, and then once the position makes 15-20 pips profit, keep stop at entry. And once they show about 20-25 pips profit, grab the profit straight away. So that the stop at entry will prevent any loss to come. Once the position has seen the profit, the market, if it reverses, you will not hold the position. It will stop out. That way you can eliminate the risk. In FX trade, data, okay, it is a conversation among themselves. Any other questions? If you have got any question, then I can answer those questions. So I will come back by 14 GMT and give the second part of the webinar. At that time, I will show you what happened to those positions, what I committed, and what amount of profit I have booked it. So your trading decisions should be as quick as possible, and it should be reliable. It is not impulsive as quickly as possible. It should be reliable so that you will have an assured profit in that trade. So I explained you a basic trading strategy. And if you continue to do this and aim 35 to 45 pips on each trade, and in the long run, you will be able to double your equity in a matter of about 6 months to 1 year. Instead of taking chances, aggressive trading, etc., wherein the headway is much limited. And in the process, some of the traders find that when they become more aggressive in trading, they commit more frequently the positions, they become addicted to trading, impulsive, and about 5 trades they lose, 5 trades they gain, and ultimately they have only done hundreds of trades to give profit to the other platform providers, but they are not earned anything in a philanthropic way. So don't be like that. My humble suggestion will be control your emotions and don't become addicted to trading. Understand you enter into the market only to earn money, extra mileage, extra income in order to lead your life comfortably. In that process, you should not lose your equity, become indebted to somebody, and you are compelled to earn that money and give back and use your credit card for depositing money in the account. All those things are nothing but impulsiveness. Out of frustration, it comes. And in that process, you find that you are defeated because you are not having the mental strength to understand the market. Then you ask somebody to guide you, somebody to hold your hand and trade, and somebody how long he can hold your hand. So there is a saying, if at all anybody can eat in this world to satiate you, only yourself can eat. Nobody else can eat, and then you feel satiated. You feel that you have taken the food. If you become thirsty, you can only drink water. Somebody else cannot drink water. So you need to understand how to do the trading and then enter into trading. It is something like learning the art of driving and going for the driving. Similarly, learn the art of trading and enter into the market. So wish you all happy trading. Then I'll come back by 14 GMT and show the results. And you can also track the market and find out what could have happened to the holding positions and how exactly I handled it because I got the hedge order to limit the risk. You can find out the results by 14 GMT. And then I'll commit the positions for the US session as well. Okay, see you by 14 GMT. Thank you.